Dan, you've been doing this for quite some time. We share a barber, clearly. As you look, as Julie mentioned, 10 years out from the financial crisis, I want to get to that, but I want to start on the news. Turkey.
Sure.
Obviously, over the past few years, it's been top of mind for investors, and there's been quite a reaction. Why? Why this big reaction to Turkey?
Well, I think the emerging markets, as a general matter, and like many other very tight fixed income markets, have had far too much access to capital. And in the case of Turkey, they took a lot of non-Turkish lira denominated debt to further their borrowing desires. And so what you see out in those markets is not only are they very tight generally, but put optionality in those markets is very, very expensive, which it indicates that the investor community views those as not only tight, but also ready to move down.
Right.
And so, in fact, we're not people who bet on those currencies. In fact, if we use them at all, we use them to hedge other risks that we have.
Okay.
And we've seen a number of currencies, that have operated in sympathy with the Turkish lira, like as an example in Argentina,
right,
where our ability to hedge there suddenly became far more difficult because market makers simply went away.
Right.
And I think you're going to see that around the world.
And so the psychology that is exposed, or the sentiment, I guess, that's exposed by this sort of reaction, how much further do we have with that? Are we foretelling something here in the broader markets?
Well, as I said, we're certainly, we don't have an investable macro view. We only know what we know from empirical data that bubbles up from our portfolio. I would say it's unclear to us whether we're in the 8th or 9th inning of the current game or the first inning of the next game. But certainly a lot of the data points that we see bubbling up across the world would suggest that people's understanding of the collateral they're financing and the rates at which they're financing it are starting to converge.
And why has that happened? Have people just gotten proverbially over their skis, been too aggressive? What's going on out there?
Well, as Buffett says, in the short term, the market is a voting machine. In the long term, it's a weighing machine. And particularly in fixed income, there's no getting around the fact that you owe your interest and you own your principal.
Yeah.
And so if too much has been lent at too low a rate, ultimately the chickens will come home to roost. And so we've been in a marketplace where credit has been incredibly easy. The issuance of loans and bonds by issuers themselves have been enormous. And the types of entities that have been out there post-crisis raised to effectively absorb that supply have been greater than they've ever been.
Well, and let's talk about that, because we have seen, it feels like something of a secular shift there in terms of who the players are in the market, going from a lot of non-banks,
sure,
into a much more. What are the real implications for that, and how may that come to bear?
Well, I'd say we're certainly in a position with the banking system where the depositor that is the recipient of deposit insurance, I think, is far safer than he or she was going into the prior crisis. However, that very same person might own an ETF or a mutual fund or other kind of asset liability potentially mismatched entity that owns fixed income and may be effectively a victim through that. And so the degree to which those are regulated in the same way is far lower. And at the same time, the suppression of rates that was driven by the monetary authorities have created such a hunger for yield that a lot of the hard work to discern what is a good and bad credit has not necessarily been done.
And so what specifically do you think will trigger the next credit crisis?
I can only think about candidates,
yeah,
right? Because you never know when it's going to come from. I can remember in 2007, certainly residential mortgages were grossly overpriced and badly structured, but so were many other forms of collateral. And I think you see a lot of the same things here, as well as non-specific collateral-specific things. So that could be anything from the extremes we've seen in corporate middle market lending, in CLOs, in the subprime auto world, et cetera, or things like an extreme data breach, an extreme fraud, a mismatch of liabilities in a large-scale fund product of some sort, plus any of the many geopolitical possibilities that are out there in an administration where there might be more of an opportunity for left-tail risks.
So you've gone so far as to say, and keep me honest here, that there's something of a moral hazard out there in terms of the way that money has been deployed, sort of invested and maybe deployed. Talk a little bit about that. What do you mean by that?
Well, at the end of the day, as the alternative investment universe has evolved, it turned out that it effectively mirrored the way that the long-only universe was developed. And so what happened was very specific products with very specific mandates were created to do a very particular thing, to invest just in Europe, just in corporate, just in loans, as an example, not to pick out anyone in specifically. And so what that happens, obviously, is you effectively have an investor base that's putting into business hammers that only see nails.
Right.
And so if someone has the opportunity to be wealthy simply by doing a very particular narrow thing, there's not a lot of incentive for them to raise their hand at the particular moment when that thing is highly uninteresting and say, why don't I just give you back the money and let's look at something else.
And the reckoning, how does it look this time around, do you think, versus what we saw almost exactly 10 years ago?
Well, I think there are a couple of interesting phenomena out there that will represent secular changes. One example is the fact that due to the tremendous, arguably overregulation of the marketplace subsequent to the crisis, a very large number of unintended consequences were created. So, as an example, certain news media have reported that the amount of inventory on Wall Street dealers' balance sheets is markedly lower. Well, that's better for the depositors to the extent that those are banks and the shareholders of those places. But at the end of the day, somebody's got to make the market in OTC securities, which are a giant pool of securities, many of which are held within relatively short duration mutual funds and other open-ended or near open-ended structures, as an example. And so you can see people being surprised when they're in a fund that needs to get smaller rapidly, where that fund can't strike a net asset value or can't find a bid for its assets. And in fact, you might recall in 2007 there were certain funds that owned mortgages that couldn't effectively liquidate and caused issues. And we're seeing some of those similar types of headlines now in other asset classes, even as we speak.
So how do you invest now? Given that backdrop, which is not, shall we say, overly optimistic for the world, how do you make money? Where do you put your money?
Well, we want to go to where they ain't, so to speak. Ultimately, if a given collateral type has accessed this type of capital, intrinsically it has moved lower in pricing because it's had access to large amounts of capital and large amounts of cheap capital itself. So loans and other assets are financed themselves. So as an example, in the securitization markets, if in consumer credit in the near prime space, those markets have had access to bank warehousing lines and securitization, and so ultimately have been priced assuming that will be the case. There are other forms of collateral within the structured finance world that were the have-nots of that marketplace, that never were able to access that financing, that were counterintuitively actually priced such that post losses in a crisis, they may very well end up performing far better than things that had access to financing at the peak. And so you see things like mid-prime and lower prime assets that might not have had access to that type of bank and securitization financing. They've been priced very richly. So you're seeing, as an example, in the subprime auto world, regular way subprime auto was one of the first things that had access to financing because it performed relatively well when compared to residential mortgages in the prior crisis. So a huge amount of private equity came in, a lot of warehouse lending, and ultimately you had something similar to what you had in residential mortgages, which is that the originators of those loans were paid to originate, not to make good loans that got repaid. Right. And so now when we look at that, we say, well, we don't want to be there, but we might want to be in, as an example, what they call auto deficiencies, which are the charged off loans after the car has been sold off. Or we might want to be in things like title loans, which in a Trump administration have had, there's been a lot more openness to accessing credit for lower rated customers who otherwise would not be able to access financing if you didn't provide that product. And so we're looking at the environment and saying, what has not been a beneficiary, what has not been a have, and how do we access that customer?